Hi, thank you everyone for coming in. I can see that the numbers are slowly climbing and everyone is slowly streaming in. It is a lazy, slow Saturday morning. And I know everyone has been struggling to get out of bed just to make sure that we can be learning a little bit of quantitative investing strategy. And great, I think today we have all our various education partners, facilitators, and even the crew from iFAST is back in station just to bring to all of us today's session, today's webinar about trading volatility. I'm Bernard, and some of you guys who have seen me before, if you have attended the last 3 sessions, thank you for coming in promptly. And today we are running a recap plus sharing of about trading volatility. And of course, we will have some of our speakers from our education partner, AllQuant, to come in to be sharing about quantitative investing. I'm Bernard, and of course, I run a team over in iFAST, heading investment advisory. And of course, with us, we have all our panelists available over here as well. Instead of me doing all the talking, I will pass this time across over to them as well. Let them be the one introducing themselves across over to you. Yeah, so I'm from iFAST, and we also have with us Da Wei. And I think Da Wei is also online. Da Wei, maybe you can unmute yourself and be sharing a little bit about how you've been working this whole festival together.
So hi everyone, this is Da Wei here. I'm one of the organizers for this Quant Investing Festival, and I'm also an investment advisor from iFAST Global Markets. And so the work I do includes managing stock portfolios, bonds, funds, ETFs, and also very importantly to take clients through a guided process on how they can run their investments, and at the same time also developing some good habits or having some good mindsets on cash management. And also a lot of times, right, when we are running investments, we always think about the many different possible strategies that we could possibly opt for, right? And definitely quantitative investing is one of the strategies, right, that we would want to consider, especially when it comes to having good risk return ratios, right? So glad to have everyone here today. Personally, I am very excited for today's topic on trading volatility that Patrick will be sharing later on, right? For this is actually one very crucial aspect of investments that we will want to consider utilizing, especially to also guard ourselves against market prices, right? So please do pay attention, and I hope you guys enjoy today's sharing. That's all from me, Bernard.
And I guess some of you guys know him not only for running the Quant Festival, which you are attending right now, but also concurrently many student-based activities both in NTU, SUSS, and I think we are running concurrent events happening alongside and parallel to this quantitative investing festival. So some of you guys see him as a familiar face. Yeah, so always reach out over to us. And I'm sure along the way, during today's sharing and today's sessions, you will have questions for any of us, for the panelists, or even a question that pops up over to your mind in the midst of the sharing later. So do send your questions in on the Q&A panel, and I think we will try our very best to be answering them. I must apologize that in the last 3 sessions, we didn't have a chance to share on everything, to answer every single thing, but we'll try our very best. And if possible, I think our priority will be to answer you live over here. If not, some through type out messages and replies, or if not, we'll try on our background to follow up across with you directly. Okay, so send your questions in along the way anytime that you have them. And maybe let me share about the next panelists that we have with us as well. And they're actually from our education partner, AllQuant. And again, today's festival is only brought to you available because of AllQuant's direct knowledge as experiences coming in to be sharing. And maybe if I can get Ingwan to share a little bit about yourself, especially for those friends who are joining us for the very first time. Ingwan, maybe you can unmute yourself and just to share with us about your work.
Yeah, okay. Thank you, Bernard. All right, welcome everyone. Really a great honor and pleasure to meet you all here in this webinar. So this is actually my 3rd session. So this will be the 3rd time that I'm actually introducing myself in this whole series of webinars here. So for those who already heard it before, so bear with me, okay? So this is more for those who are attending the webinar for the first time today. Okay, so my name is Nguyen. I'm one of the co-founders and partners in AllQuant. So essentially, we're a company that specializes in educating the retail investors in quantitative approaches to investing. And these are not your typical strategies such as stock picking, value investing kind, right? So these are more non-conventional strategies in the quantitative area that we adapted from hedge funds that we used to run ourselves. Okay, and aside from that, right, we also work with the industry, be it in the area of like educating the general public or promoting more investing options for the everyday investors. Okay, and before starting AllQuant, I spent like maybe about 15 years of my professional career across asset management, banking, and hedge funds. I first started off as an investment associate in GIC. So back then I was responsible for like conducting investment due diligence on hedge funds for the purpose of allocating money to them. And after my stint in GIC, I moved on over to the investment banks, Credit Suisse and Barclays. And over there, I did something a little bit different. I was responsible for like valuation control matters regarding like complex structured products, exotic rates products, fund-linked products, or that the banks trades with their institutional clients. And after the banks, I moved over to prop trading for a couple of years, where I traded like interest rate futures spreads as well as a couple of stuffs, right? And then finally, I moved on to join a local-based hedge fund called Liquid Value Asset Management. And over there, right, I was the portfolio manager for one of the multi-strategy fund, which I co-managed together with Patrick, who will be speaking to you after this. Okay, so the multi-strategy approach, right, that we adopted for the hedge funds, what is kind of what we adapted, right, for use today within AllQuant. And that is also what we're advocating to our students and clients as well. Okay, so this is a nutshell about me. So I'm going to move back over to Bernard for him to introduce the next panelist. Okay, back to you, Bernard.
Thank you, Eng Guan. And of course, with us, we have the other co-founder and partner within AllQuant, Patrick, over with us as well. Patrick, really need your help to share a bit about yourself.
Yeah, sure, Bernard. Thank you. Good morning, everyone, for those who are tuning in from Singapore, and a very warm welcome to our other global audience whose time zone will be different from ours. So thank you for tuning in wherever you are. So my name is Patrick, and I'm the co-founder of AllQuant together with Eng Guan. So before starting AllQuant, I've spent more than 15 years in the industry, starting out first as a portfolio manager in UBS Private Bank, where I helped to implement discretionary portfolio mandates for private clients. Then after a couple of years, an opportunity came up to move to Hong Kong to work for an investment bank, where I covered hedge funds and institutional clients who wanted to trade equity derivative products like options and swaps. Then eventually I moved back to Singapore to join Credit Suisse Product Control Department. So my job there was to review structured rates and FX structured products, which are traded by the bank. And so ultimately I ended up running money in the prop trading and eventually in a quantitative hedge fund together with Eng Guan. So I'm going to share an interesting topic today on volatility trading. So this is something that is pretty much related to my work back in the investment bank in Hong Kong, where I covered the hedge funds who were basically trading derivative products. So the main reason why they trade derivative products, right, is that they want pure exposure to volatility. Okay, so I'll talk more about this subject later on. So, but for now, just hand over the mic to Bernard. Thank you.
Thank you, Patrick. And I must say, I'm waiting to hear about this part about trading volatility, especially, of course, I had some insider news how you were using different ETFs, exchange traded funds, to have a leverage play on this. And of course, all these strategies in place has always been an exclusive directions for the accredited investor, meaning the ultra high net worth markets. And I think today, through all the very educational opportunities that you guys have provided, you have opened up and exposed us as a retail investor and even as a learner to all these strategies that were previously not available to many of us. Yeah, and of course, as what Patrick has shared just now, many of you guys are joining from a different time zones. And as I look across the attendees and the participants, thank you for those in the more extreme time zones. Although we are 11 a.m. over here in Singapore, some of you guys are at 11 p.m. and still having a very studious, conscientious mindset, joining us all the way from the eastern and western states of US. Thank you. Yeah, and of course, we don't want to just start rudely over here, but rather having a quick recap of what we have done in the last 3 session. Maybe we can hand over to our educational partners and maybe just a quick recap on the last 3 sessions before we let Patrick come in to share with us about trading volatility. Yeah, our AllQuant friends, please.
Okay, Bernard, you want to switch over to the slide? Yeah, okay, thank you. Okay, basically just a recap of what I presented during the first 2 sessions. Okay, especially for the benefit of those who've never attended. So basically what I did on the first session was I talked about a very important thing, right? That is often neglected when retail invest. Okay, and that is risk. Because if you just focus on risk alone, right, then you're really missing out on the other half of the picture, right? And why is risk so important? Right? Most people tend to relate to risk to what? To losses, right? But it is actually more than that, right? It is also a gauge of uncertainty or the level of uncertainty in an investment outcome. And a lot of people that I know or that I talk to cannot relate themselves to what uncertainty actually is. So at the webinar itself, right, I showed this particular slide, right, to get a point across. So what we essentially have here, right, is the outcome of a 20-year investment plan. Okay, and the plan is this. So basically what you did is you invested $120,000 into global stocks at the start of a particular year. Okay, and then after that, you're going to hold it for the next 20 years. And your target, right, for this is to grow your portfolio to a value of $660,000, which is going to work out to be about 8.9% per year. Okay, because that is the average yearly return of the global stocks between 1970 and 2020. Okay, and the blue line here, right, represents what you're going to have after 20 years. So for example, let's say if you invested in the year 1970, then what you're going to have is about $1 million or slightly above $1 million after 20 years. All right. But if you invested, right, in the year 1999, which is the year you start, then 20 years later, you're going to end up only with $231,000. So as you can see from here, the range of possible outcomes is huge. So you can end up with anywhere from as low as $230,000 all the way to like $1.5 million, okay, depending on which year you actually start. And if you plot out the possibilities or the probability of you missing the outcome, it is actually not small, right? So there's actually a 50% chance, right, or half the time, right, depending on which year you start, you're going to miss your target, right? And the amount of shortfall that we're going to talk about when you miss your target is not trivial or small as well. Okay, the average shortfall is about 45%, which means you only meet half the target or about half of it, right? And the maximum can go up to as high as 65%. That means you only meet 1/3 of what you wanted to achieve. So if that really happens, then that can seriously derail whatever plans that you're going to have then, right? Because what are you going to do next? Are you going to have another 20 years or 30 years of investment plan waiting for you to kind of rectify or catch up with whatever you haven't meet now? All right, so this is what we actually meant by uncertainty. Okay, Bernard, can you switch to the next slide? Thank you. Okay, then after that, I shared on how you can actually manage risk to lower the overall uncertainty of your portfolio. And actually, the first and most effective line of defense is already what most of you are familiar with, and that is to diversify. Okay, but the thing is, this is not a run-of-the-mill diversification that most of you are familiar with. All right, there are actually many different levels of diversification, but most people do it at what we call the most basic level, which is diversification across securities within the same asset class. So as example, you may diversify across different stocks in different sectors and countries. Okay, that is also diversification, but it offers you limited benefits, right? Because when a major stock crisis comes along, you can be sure that all your holdings, all your stocks are going to go in one direction, and that is going down. Okay, so that's where you can consider moving up one level above, right, to look at diversification across different asset classes. Now, the financial markets is actually way more than just stocks. Okay, although most of you are only familiar with stocks. There are other asset classes. There are bonds, there are commodities, there are currencies, there are real estates. No, there's also volatility, right? An asset class, which I think Patrick is going to share on later, right? And each asset class have their own characteristics and behavior, right? So they can behave differently, right, from each other within the same market regime itself. So for example, let's say stocks will crash in a crisis, right? But government bonds, on the other hand, are going to rally, right, during such times. At the same time, volatility is going to surge, right? And those who are long volatility are going to benefit, right, from volatility as an asset class as well during such times. So a good choice of different assets, right, can actually help you to complement each other and even out the profile of your return series so as to overall lower the risk, right, of your portfolio itself. Okay. But that's not all we can do. No, we can even move one level further up, and that's to look at diversification across different types of strategies. And there are many, many different types of strategies out there. So with strategies, well, then your options are a lot more wider, right? Because if you look at it, right, strategies are like different traders, no, each having their own skill sets and methods to actually make money out from the market itself. So when one is going through a rough patch, right, another may actually be having one of his best times. So they can actually like work as a team and help out each other to try to even out the profile and make your risk of the portfolio even lower, right? And to help you achieve a much better, what we call risk-adjusted returns itself. So a good blend of strategies across different asset classes, different markets, different securities can actually greatly reduce the risk or uncertainty of your portfolio. And if you do it right, right, it can also deliver you good returns. Okay, diversification when done right does not necessarily compromise on the returns that you're going to get. Okay, but next slide, please. Okay, thank you. So after that, I showed the model performance of the multi-strategy portfolio, right, or that we ourselves have constructed. And this portfolio can actually also be implemented with the help of our iFAST global advisors here, Bernard and Dawei. Okay, it is diversified across different strategies, different asset classes, and different markets or countries, right? We predominantly use ETFs for these particular strategies. And one of the strategies inside is a vol trading strategy, which I think Patrick is going to be touching on later on as well. Okay, so the thing is, when you diversified in the right approach, you can potentially achieve, right, not only a higher return. So that you can see from here, right, the return of the multi-strategy portfolio is 11.4%, right? And that compares favorably against the global stock market, which only gives you 8%, and the Singapore stock market 7.5%, right, over the period considered from 2005 to 2021. Okay, and the more notable thing is the risk level taken. All right, so if you look at the volatility of the risk taken, the multi-strategy approach actually takes only 8.8%. And that is much lower than 15.5% for global stocks and almost 22%, right, for Singapore. Maximum loss is also quite muted and fairly acceptable. Maximum loss is about 12% for the multi-strategy portfolio. And that compares very well, right, against like 50 to 60% for the stock markets, right? Because when the bear market comes along, this is what you can expect to lose, right, with the stock markets itself. And if you were to zoom into the chart where there were the circuit areas there, right? So these are periods where the stock markets actually experience major crises or pullbacks, right? So inside that, there are 4 periods. We have the great financial crisis in 08-09. We have the market sell-off back in the late 2015 to the early 2016. Then we have the last quarter market sell-off in the 2018, which is due to the US trade war tensions as well as a hawkish central bank, breathing down on the markets. Right. Then finally, at the last period, we also have the COVID-19 pandemic sell-off in 2020, which lasted only less than 2 months. Okay. Now, throughout all these periods, you can actually see, right, from the profile of the multi-strategy portfolio, which is a blue line over there, right? It remains fairly stable. It did not experience any huge fluctuations. So in fact, it actually made some money even coming out of all these tough periods itself. So that is why we say that it is important to pay attention to risk, and it would be very useful if you know how to manage it, right, to actually run a portfolio. Okay, so this is roughly the main highlights for the very first session. All right, Bernard, can you show on the next slide? Thank you. Okay, so this is the second session. All right, so in the second session, I basically introduced quantitative investing as an approach and how it is different. All right, basically what happens is that quants tend to use data and models to drive their investment process. On the other hand, most people are what we refer to as discretionary investors. Okay, and they may use a blend of like qualitative or quantitative data to invest, but more perhaps leaning towards the discretionary side of things. And the difference, right, between the two approaches can kind of like immediately summarize into this one slide, which I showed during the webinar session itself. Okay, first, I think discretionary tends to rely quite a fair bit on what we call intuition, right? based on what you think and what you feel. Quants, on the other hand, they only relied on evidence, right? Science, math, and everything to drive their decision itself. And the second thing is that all of us, when we kind of analyze things, we work based on some sort of rules. All right, it's the same with both discretionary and quants. Okay, but the thing is, with discretionary, the rules tend to be very loose. These are often kind of like internalized to their own experience. All right, and that is why you'll find discretionary investors often flip-flopping about their decisions, and sometimes they themselves, right, cannot really articulate very clearly why they make certain decisions. And we boil down that to gut feel. Okay, so with quants, there is no room for such ambiguity, right? Because we work only with precise rules that can be traced and that can be explained with each and every decision that we make. Okay, third is very obvious. The third point, okay, a discretionary investor, let's say you're a discretionary investor, then you will be the one that pull the final trigger. Okay, what to buy, what to sell, how much to buy, how much to sell, and when to buy, when to sell. So you'll be the one calling the shots down here. But with quants, or the hardcore quants, right, all these are determined by the model. The model is going to tell you what to buy, what to sell, how much to buy, how much to sell, and when to buy, when to sell. So the model is the boss here. They call the shots. Okay, and finally, right, because humans remain a very key central element in the investment process for discretionary investors. So discretionary investors will tend to face issues like biases and emotions, right? And as a result of that, they have a challenge, right, in terms of producing consistent results. Quants, on the other hand, right, we wouldn't have such an issue, right? So if I would have passed the very same model to, let's say, 10 different people, and if all 10 of them were to kind of follow the model down to the dot, I can guarantee you they're going to produce very similar results, right? So with a good model, right, a quant result can actually, or potentially, right, be repeated in a consistent manner. Okay, Bernard, next slide, please. Okay, then after that, I also talk about the most important process within quantitative investing, and that is the modeling or the backtesting process. So the backtesting and the modeling process is the cornerstone or the backbone, right, of quantitative investing, because that is where we come up with ideas, we do our research, and we validate and see whether a particular strategy or idea is actually working. Okay, and contrary, right, to what a lot of people think, this process is actually very elaborate and rigorous, right? So that at the end of the day, whatever results that come out is something that you can actually rely on, trust upon, right? And why do quants, right, rely so much on modeling? What is the benefit of it, right? Because modeling helps you to answer a lot of important questions and provides critical insights, right, into your strategies. For example, you can answer questions like, well, does my idea even work at all? I mean, if it doesn't even work after I test it, why should I be running it? So it's not based on what you think, what you thought, no, or I think this is going to happen, that is going to happen, right? Put it to the test and see if it happens or not, right? If it works, then that idea is worth pursuing, right? If it is not, then you probably got to shelf it, right? Then you can also answer questions like, how much can I make on average? Well, not based on what I think again, right? So this is actually what would happen or how much I can make if I put this to the test within the historical market itself. Okay, and how much is my maximum loss? Very useful, because with every kind of strategy that you use, you want to have a good idea of potentially how much you can lose. In particular, in a very bad scenario, how much you can actually lose. So a good modeling process that covers enough different market regimes over a good length of period itself is going to shed a lot of light on all those things. You'll be able to answer such important questions, right? So that internally you have the expectations of how much, right, can I lose when you actually go and deploy the strategy itself, right? And did this strategy behave in line with my expectations, right? Or when does it do well? When does it do badly? What are the strengths and what are the weaknesses, right? And overall, is it good as a standalone strategy? If it's good as a standalone strategy, now if I want to fit into my larger portfolio, which runs other strategy, is this strategy a good fit for it? Does it improve my overall performance? So is it worth adding in? So these are a lot of important questions that you can ask, right, when you do the modeling process itself. Okay, all right, so these are mainly the highlights of the two sessions which I shared with during the webinar. Okay, so that's about it for now, right? So all right, back to you, Bernard.
Hey, hi, thank you, for sharing all these things. And of course, as a quick recap, we also have some questions that's coming in. Yeah, and just like I check, Ingo, are we going to want to share a little bit about our day 3 session, or we can head straight into our Q&A for the panelists?
Sorry again, Bernard?
Yeah, so I think we should head straight in for a few questions across the panelists.
Okay.
Yes, and there was one question that consistently has been coming up across in the last few days when we were presenting. It's really about hedge fund strategies, and we also use this term called quantitative investing. Yeah, just a check, maybe across even from Patrick and Ingwan, any answers across from you that really what was the difference between hedge fund strategies and quantitative investing, or are they actually the same thing, and we can actually interuse these two terms across?
Okay, I'll go first. Okay, so basically hedge funds is the funds, okay, and it uses a lot of different strategies out there. So there are like fundamental investing based on value investing hedge funds. There are also long short hedge funds, statistical arbitrage hedge funds, global macro hedge funds. So any type of strategies you can think of, you can probably find it within hedge funds itself, right? Because they are lightly regulated, and they can only target what we call the high net worths as well as institutions. And as a result of that, they're given, like, the regulators give them a wide latitude to pursue the different kinds of strategies that they want to do so, right? Because the high net worth institutions are more likely to be able to have the kind of expertise and resource to kind of conduct the proper investment due diligence on hedge funds itself. Okay, so that's hedge funds. Okay, a quantitative investing is an approach, right? So just like your discretionary investing approach or your fundamental investing approach. So all these are approaches or various different ways that you can kind of like invest within the market itself. So in a way, they are, you look at it, they are, you can say that they are related, but they're two different things as well. So the hedge funds can employ fundamental investing, right? They can also employ quantitative investing. It really depends on what sort of strategy or their mandate is, or what type of thing that they want to pursue at. So with us, right, we are from the quantitative side of things. So the hedge fund that we used to run are basically based on quantitative strategies. So that is where we're coming from. Yeah. So yeah, in general, in a nutshell, that's about it on my side. So if Patrick, you have anything to add, you can add in there.
Okay, so for me, right, so basically quantitative investing, right, would be a subset of the broader hedge fund universe. So in fact, within the quantitative investing space itself, right, you'll find that there are actually a lot of different quantitative strategies out there. So it's already a very broad universe by itself. So you can imagine that for the broader hedge fund world, right, it is even a lot more diversified in that respect. So what is the reason why typically retail investors are not so familiar with hedge funds? Is because the authorities has made it so, right? I mean, regulators have basically regulated this industry very tightly to make sure that hedge funds are only available for the high net worth institution. So they deem that these people are savvy enough to be able to distinguish between what are really the good hedge fund managers and what are those that and who are those that basically just trying to pull a fast one. So the thing is, because really, I mean, anything out there, right, can be classified as a hedge fund. Even your traditional long-only equities funds, right, they can also classify themselves as a hedge fund. So it really depends on the kind of structure that they want to set up. So if they want to only restrict themselves to high net worth institutions, then they can set themselves up as a hedge fund structure. Then they won't be able to touch the retail crowd. But if they want to target the retail crowd, right, then they cannot term themselves as a hedge fund. Then obviously they'll be under a lot more different set of supervision. So the thing about whether should we really use hedge fund strategies or not, right? It really boils down to this question of so do you really want to be affected by what happens in the general market, right? So whenever there is a recession or there is a crisis, right, do you want your portfolio to be affected by it? And when I say affected, it can be, affected very badly. Like you can lose like up to 50% or even more if the crisis is severe enough. Of course, a lot of people will say that, oh, it's okay, the crisis will pass and the market will always recover. Well, that might be true, but the thing is, I mean, if you have ever been through a crisis, right, you will know that the psychological impact on you when you go through a crisis, right, it's really very, very real. Okay, you will really feel it, and a lot of people actually couldn't take it. And what happens is that they basically bail out at the worst possible time. Okay, then the losses would then be crystallized, and it's forever a loss there. Okay, so I think hedge fund strategies, right, why it really started off is because the first hedge fund that was basically founded in 1949, right, is that the philosophy is that they want to basically create a portfolio that is resilient to the broader market out there. So if let's say the market were to crash and burn, right, the portfolio will still be performing relatively all right. Okay, so that is really the starting point for the invention of hedge fund. So obviously along the way, then a lot of different hedge funds strategies came about, and so it's become like the message is a bit lost, right? But ultimately, I think at the very foundation of hedge funds, right, is that there is this philosophy of wanting to manage your risk. Okay, but the problem is risk, right, is actually not so simple. Okay, there are a lot of different types of risk out there. So a lot of hedge funds thought that they have already mitigated all the risks that they can, but actually they ended up ignoring a risk, right, that is actually still affecting them in the fund. So a very good example, right, is the LTCM crisis back in 1998. Okay, so back then, right, LTCM was one of the pioneers in quantitative investing. So they set up this fund with a group of PhDs. These are all very famous people. So they put up a lot of arbitrage type of strategies, right, that are fully automated. So basically what they do is they go long a certain instrument, and then they go short on another equivalent instrument. But the idea here is they are basically trying to capture some kind of inefficiency in these pairs. So the thing is, they thought that they already hedged all their risk properly because they've diversified across as many different spreads as they can, across as many different asset classes as they can. But the problem is that for spreads to work, right, they rely on this thing called liquidity. So under normal liquidity kind of a functioning system, right, yes, spreads that diverges, right, typically will narrow themselves back after some time. But then what happened is that in the liquidity crisis, right, the spreads can basically blow out, and this blowing out the spreads, right, will affect all the different positions that they're put on. And so because they have neglected this aspect, right, they are very overconfident in their strategies that they pile on a lot of leverage. So because of the leverage employed, right, they were able to return like 40% plus returns for the investors. So obviously that was very helpful to them in terms of bringing in a lot of new capital. So in fact, the fund grew very fast, and within a short span of time, they were managing over $1 billion. Now, back in those days, right, $1 billion fund is really a big deal. So obviously in 1998, right, the Russian default happened, and that really sparked off this liquidity crisis, and a lot of people basically just flocked to all the safe instruments and all the safe havens. So all the positions that they have, right, even though yes, it's across different asset classes, across different markets, and as diversified as you can find them, they find that they are all basically blowing up right at the same time. And because of the leverage that they are piled on, right, very fast they find that their loss is basically too much to handle. And eventually, obviously, we know how the story ended, right? So the point here is that, yes, we should use hedge fund strategies, but at the same time, right, it is not so simple as to say I want to use hedge funds, but you really need to know the nitty-gritty aspect of what the hedge fund is doing, how they are managing their risk, and whether are they really as diversified as they say that they are. All right. So I mean, it's quite a specialized area that we should be careful about. Yeah, that's all.
Yes, thank you, Patrick. Of course, what I can really digest and put into concise terms is that there are really quite a few. Recognize what are the true helpful strategies, and really bringing advice or even the good knowledge to be able to determine which is the better strategies to use. And of course, based on all these strategies that we talk about, there's always something that highlights across to the investment space, talking about passive income, and using passive income, having strategies that yield passive income. Maybe I bring this back over to Patrick as well. Will you be able to share with us in a few lines to talk about this passive income possibility?
Yeah, sure. Okay, so in general, I would say that there are two ways of creating passive incomes. So the first way, I think we're all very familiar with it, and it is quite similar to how we earn a regular income through working, right? So we basically put in our hours, go to work, and then in return we get a regular stream of income that comes in every month. So this first method of generating passive income is derived through assets that basically generates a stream of income in the form of be it rentals, be it dividends, be it business profits. Okay, so but what's underlying all this income stream, right, is the asset that is used to generate them. Okay, so a lot of people like to put them into different buckets. So there are these mental accounting bias whereby they bucket the revenue stream from rentals, dividends, coupons into one bucket, and then in the other bucket, they have their underlying investments, right? So they are focusing more on the first bucket, which is how much revenue stream can I get back from my dividends, from my coupons and all that. And then for the capital bucket, right, they tend to put less emphasis. So they are not so concerned about the value of the securities that they're using to generate the revenue stream for them. Okay, but the thing is that doing it in this manner, right, there is a danger in that your underlying investments can get affected very severely, right, in the market crisis, and that would in turn have an impact on the revenue stream that you're getting. So a very good and famous example is back in 2008, right? Citibank, right? Citibank, they have been paying out dividends regularly, but because they were so severely impacted by the great financial crisis, right, that they are forced to cut dividend. Okay, so imagine those people who have been relying on the dividends from Citibank, right? Suddenly they realize that, oh, I got no more income coming in from that security. Okay, so that is one way that people look at passive income. Now, in the second way of looking at passive income, right, is that you really don't care about where it is coming from. So you basically don't care whether is it coming from capital gains or is it coming from dividends or basically regular coupons. So even if, let's say, the underlying investment that you have, right, it pays out dividends, these dividends will basically just go back into your overall portfolio for it to be reinvested to continue to grow. Okay, so then in the event that you want to create a regular form of passive income for yourself, right, what you can do is that you basically sell down your portfolio on a regular basis. And so in that manner, you basically generate cash flow back to yourself. Okay, but of course, you must make sure that your underlying portfolio, right, is able to sustain that withdrawal rate. So I'm going to talk more about this topic, in fact, in another webinar next week, okay, where I'm going to talk about generating passive income using this second approach. So in order for this approach to work, right, first of all, you need to focus on two key factors. The first one is that you need to make sure that whatever strategies that you're using is able to generate a sufficiently high enough returns in order to sustain the withdrawal rate that you want for yourself, okay? And the second point, which is very, very important but often overlooked by people, is that you need to make sure that this underlying portfolio, right, it's resilient across all kind of market conditions, so that you won't be adversely affected and then realize that, oh, my portfolio is shrunk by half, and yet I still need to sustain that withdrawal rate that I have. Okay, because if you continue to withdraw at that sustained rate, right, what will happen is that your portfolio will shrink even faster, and it will become very, very difficult for your portfolio to grow back to its original size. Yeah, I'll talk more about it in the next upcoming webinar. Okay, so that's all for me, Bernard.
Thank you, Patrick. Actually, what you shared strike a chord across over in me, because you shared about the technical aspects of that passive income. And actually, likewise, for myself, in the third week, I'm going to run through to talk a little bit about that recurring income and how in my own personal practice, we use it for trust funds, for foundations, and sometimes even for philanthropic groups. Yeah, so we will leave this question towards the third week. And that's where Patrick and me will be sharing in two different sessions regarding our passive income and recurring income. So linked to this, maybe let me direct one of the question over to the other panelists, Da Wei. Since today we're going to talk a fair bit about volatility. Da Wei, we have any thoughts regarding about volatility and different aspects of volatility, especially in your own practice? Because in your practice, you are very front-facing across with clients, with families, and with businesses. Yeah, would there be any insights that you can share with us regarding about volatility?
Yes, sure, definitely. So from experience, right, what I do see a lot of times is that whenever the market is falling, investor emotions, it really tends to run pretty high. Okay, and this is especially true for those who have invested only for a few years, or maybe you have not done so even for more than a year. Right? And that's going to be the first time when you feel that emotion and that worry coming in. Right? And this is actually a state where we tend to forget about a lot of basics about investing. Right? Even things like knowing that the market actually goes up in the long run, right? At that moment, we may not forget about it. Right? So when it comes to managing this situation, it is really very important. Right? On one hand, yes, we need to come back to the basics and remember how our investing philosophy and how our investing approach actually works at first. Right? But on the other hand, right, I also want to maybe touch on a little bit and elaborate a little bit more on what Ingwan and Patrick shared just now. So Ingwan did share that there are different means or different levels of diversification. And a lot of times, traditional mode of investing, right, we only tend to diversify across securities and diversify across asset classes. Right? And what this leads to is what Patrick mentioned just now on how our portfolio, right, no matter how many asset classes or how many securities we have, how diversified we are in those levels, we are still going to have that situation whereby when the market is falling, our portfolio, it goes down accordingly, right? And yes, we can cushion this through a number of ways, right? Through using bonds, through using gold, through using things that have a lower correlation with the rest of the general equity market, right? But at the same time, we are still going to see that these correlation, they are still low, but they are lowly positive, right? They are very rarely negative, right? Even for bonds. Right? So if you have invested before COVID actually happened, you will see that when the market fell, right, generally when the equity markets are falling, we expect bond prices to rise, right? Because bonds are generally considered a more safe haven compared to stocks. But what happened during COVID was that actually people started to sell their bonds as well, and this was really out of fear and out of also some practical means as well. So there are also many investors in the universe who are operating through margin, right? And upon margin calls, right, this means that you actually suddenly have to fork out an amount of money to top up your investment account so that you can continue with your trading and borrowing money to invest, right? So in this situation, it was really very common to see a lot of investors, right, through banks, through investment platforms, right? They suddenly have to fork out this amount of money and they have no choice but to sell their bonds, even when it's at a lower price and it's at a loss. Right? So even for situations like this, we are going to see that positive correlation with the rest of the market. And this is where your quant investing or hedge fund strategies are going to come in to help and assist you, right? Because you really need to look out for and explore on some options that can give us a little bit more negative correlation with the rest of the market. Right? When our volatility is spiking and we are really very uncertain how the market is going to move, right? This is when that low and negative correlation is going to come in very, very helpfully. Okay. So in terms of why I use hedge fund strategies, right? This volatility topic that we're going to talk about today, it is one of those possibilities and strategies that we can use to really help us hedge our portfolios, right? And instead of our portfolio dropping, right, we may secure it, right, level it, or maybe even increase our investment value when we are facing these situations. So yeah, that's something that we really want to look at.
Thank you, Da Wei, for sharing on that. Yeah, wonderful. And I think it's always great that we hear from the technical aspects and now from the consumer angle, especially since Dawei, on your side, you have been interacting across directly with clients. Yeah, and of course, at this point in time, I want to share about the great things that this collaboration between iFAST and also AllQuant has been working on. We always maintain on that CSR, corporate social responsibility angle, and within our firm, we have always enforced that it is important to be running corporate or even students level financial literacy. So we've been going around to schools, going around to even companies, ensuring that people know about what's in their portfolio, in their finances, even before they make any decisions to start investing. And of course, in the last few weeks, I have seen multiple sessions where a student challenge was being ran, and it's still ongoing right now. And some of the participants coming from NTU, from SUSS, and I do see many of you guys are actually online right now. Of course, we are going to end off. There will be a presentation across with some of the students on how they're going to suggest on deploying a portfolio of $100,000, especially with the using of alternative strategies that we shared in the last few weeks and the next few weeks ahead. Yeah, and of course, towards the some of you guys who have been with us for the last few days, do watch out. Yeah, watch out for the next few sessions. We still have 2 more weeks going on. If you have only signed up for today's sessions, you may want to follow on back over to the link to sign up for the next few sessions, because our whole festival is run virtually, and only if you have the Zoom link are you able to personally participate. Yeah, because some of the videos, again, due to our proprietary requirements and compliance limitations, may or may not be online or further shared. So we do encourage you sign on using the links such that you'll be personally invited via Zoom onto our next 1 to 2 weeks sessions. And of course, towards the end of today's session, we will still be coming with 2 quiz questions to accumulate as part of the lucky draw for our whole festival awards. And just to let you guys know, our education partner AllQuant will be sponsoring some course packages to support the educational requirements of all our participants over here. Yeah, and now here, maybe I should hand over that time backwards over to Patrick, where he's going to be coming back in to be sharing about trading volatility. So Patrick, when you're ready, you may want to just share your slides and take over from here.
Yep, let me just pull out my slides first. Okay, right. So during the first week of this festival, right? So Ingwan briefly introduced one of the quantitative strategies we run at AllQuant called Volatility Risk Premium. He mentioned how this strategy is unique because it is uncorrelated with many other asset classes, and it is also primarily responsible for saving our multi-strategy portfolio during a stock market crisis. Now, for those who are attending the festival for the first time, not to worry if you have missed the earlier session, because I'll be sharing more on this topic today. But first, I would like to mentally prepare some of the audience here today. Volatility might not be so familiar for some of you, especially if you do not know option theory. Okay, but this is normal, as this is quite a specialized area, even among investing professionals. Now, however, it is worth paying attention because it might help answer one of the main concerns when it comes to investing, and that is how to protect an investment portfolio or even profit during a stock market crisis. Now, professionals have been trading volatility for many years using institutional products that is out of reach for the retail investors. For example, during my time working with hedge fund clients, one of my clients was a pure volatility arbitrage fund, and they actually made billions of dollars for their investors during the great financial crisis back in 2008. Now, so back then, pure direct exposure to volatility was not possible for the retail investors because there was a lack of instruments to use. But in recent years, right, volatility-linked exchange-traded products that are traded like stocks have allowed retail investors to also trade volatility. I'll introduce 2 popular exchange-traded products later on that allows you to either go long or go short volatility. Now, one last thing before I start, Professionals often use the short form vol to refer to volatility. Okay, so I'll be using vol and volatility interchangeably during the session. Okay, I will not be able to cover everything there is to know about volatility in one short webinar. So for today, we will focus mainly on understanding what is volatility. Okay, I will broadly cover the following items. We will see that volatility measures how much a security's price can change from one point in time to another. We will see that there are actually two types of vol that may sound similar but are really quite different. As the name suggests, one is an implied or derived measure, while the other is an actual or realized measure. Now, professionals often talk about the vol term structure, and they try to analyze the state of the market based on how the term structure looks like. So we will also take a brief look at what this term structure is. Okay, volatility is often used as a tool to hedge an equity portfolio because there is a tendency for vol to rise when equity markets fall. In fact, when compared to many other asset classes, volatility stands out as being uncorrelated. And last but not least, volatility is a wild beast. Okay, there is potential to make a lot, but at the same time, there's also potential to lose a lot when trading vol. Okay, we will look at why this is the case later on. Okay, so first, let's look at vol as a measure of price fluctuation. Nothing explains better than putting the price chart of two polar opposites next to each other. So on the left, we have the utility sector for the US market, which is among the most stable equity sector when it comes to price movement. You can see that the price doesn't really change that much over time, and the price range is pretty narrow. In this case, it ranges somewhere between $44 to $54 over a span of 1 year. So this is what low vol looks like. Okay, on the right, we have the king of cryptocurrency, Bitcoin. So if you like excitement, right, then this might be what you want to trade. You can see that the price can change drastically over a short span of time. It can be priced anywhere between 3,000 to 9,000 over the same 1 year period. Okay, so this is the behavior of security that exhibits high vol. So generally, you can say that low vol is associated with low risk and high vol is associated with high risk. Okay, so next, let's look at the first type of volatility called implied vol. Now, the formula that you see here, right, is called the Black-Scholes formula. There is no need to remember or memorize this formula. All you need to know is that this formula calculates the theoretical price of a call option given certain information about the underlying stock, such as the current stock price and the future volatility of the stock price. So there are a number of assumptions underlying this formula, one of which is that the future volatility is known. Okay, but this is not realistic as the future is really unknown, right? So therefore, in the real world, the price of the call option is actually driven by the trading activity, right? The supply and demand for the option. And the future volatility is then backed out from the actual traded option price using this formula. Okay, so hence this type of volatility, right, is known as implied vol because it is really implied from traded option prices. Okay, so next, the other type of volatility is actually a statistical measure based on what actually happened. So for example, if you want to know the actual volatility for the S&P 500 over the last 1 month, we can plot the daily return of the S&P 500 index over the last 21 days. Okay, so why 21 days? So if you know, right, there are 252 trading days in the US. And so the average month has 21 trading days in it. Okay, so that is why we use 21 days. So then the horizontal red line, right, is then the average daily return over the past 21 days. And the blue dots are the actual daily returns. So we can measure the gap between the actual return on each day and the average daily return as marked by X. Okay, then we can calculate the standard deviation of the daily return over this period just using a formula. So this statistical measure, right, is then called the realized volatility. okay, because it is actually what happened over the past, right? It is not based on some speculative prediction of what the future is going to look like, right? So there is a loose relationship between implied and realized vol. You can think of it as a rubber band that is connecting the two. They tend to move together, but there is always a gap between them. Implied vol is trying to guess what the future price fluctuation looks like, while the realized vol is measuring what is the actual recent fluctuation that transpired. So if I were to use an analogy, right, imagine driving in a car. Implied volatility is like looking ahead of your windscreen to look at what is ahead of you, while realized vol, right, is like looking at the rear view mirror and seeing what has already gone on behind you. Okay, so historically, implied vol tends to be higher than realized vol. Okay, this is likely due to hedging activities of institutions who buy put options to hedge their equity portfolio. So this activity will tend to drive up option prices. And so there's always tend to be a premium in terms of what people are pricing in terms of forward-looking implied volatility versus what has actually happened subsequently, right? But having said that, there are times when realized volatility is higher than the implied vol. Okay, this usually happens when there is an unexpected crisis that drives stock prices temporarily into a period of turmoil. Okay? So now let's look at how volatility can be used as a hedging tool in a portfolio. So there are many different hedging activities out there, starting with the simplest one of just buying put options to protect the equity exposure in a portfolio. The only problem with buying put options is that most of the time you are simply throwing away money in the form of paying premiums. So this is a bit like buying insurance policy for your portfolio, right? So at AllQuant, we run a vol trading strategy called Volatility Risk Premium, which capitalizes on the gap between the implied and realized vol. So the strategy, right, is expected to generate returns in the long run. And at the same time, it potentially acts as a hedge during market crisis. Okay, it is a part of our multi-strategy portfolio. So I'll just use the volatility premium strategy to illustrate how it acted as a hedging tool during the peak of the COVID-19 crisis in the early part of the last year. So the dashed red line, right, represents the S&P 500, while the blue line represents our volatility risk premium strategy. So at the peak of the crisis in March, the S&P 500, right, dropped 34% from peak to trough, okay? This led to a spike in implied vol as many stock market participants scrambled to buy protection for their portfolio at the very last minute. Okay, at the same time, option sellers are highly uncertain about the crisis and were only prepared to sell options at a very high price. Okay, so just before the crisis erupted, the volatility risk premium strategy started to go long vol, and as a result, right, benefited greatly when implied vol spiked up. So this led to a gain of almost 100% in the strategy. So you can imagine how this strategy, right, more than covered for the losses in the other parts of the multi-strategy portfolio. And then subsequently, when the crisis peaked and markets started to stabilize and recover, implied vol came down and the volatility risk premium gave back some of the profits made earlier. Okay, but this is all right as the rest of the portfolio recovered, and at the overall level, the entire portfolio did well. Okay, so this is a look at how the multi-strategy portfolio performed last year. You can see that it avoided the sharp loss in March while the S&P 500 crashed. So this is the part where our volatility risk premium strategy played a huge role. And subsequently, it continued to move up for the rest of the year, led by the rest of the strategies, while volatility risk premium now take a back seat, right? So in the end, the multi-strategy portfolio managed to chalk up 22% gain for the full year. The S&P 500 also managed to end the year well, but bear in mind that you have to go through that roller coaster ride, right, in the early part of the year. Okay, so the inverse relationship between volatility and the S&P 500 is not only restricted to last year. Okay, this is a longer-term comparison chart between our volatility risk premium strategy and the S&P 500 going back to 2011. So the period circled in red is what we have seen for last year. So over the longer period, starting from 2011, right, you can see that both lines are actually going up over time, But there are many instances where when one is up, the other is down. Okay. In fact, the blue and red line crisscrossed on a number of occasions. So this is really what we want to see if we want uncorrelated return streams. Okay. So in fact, we can actually calculate the correlation between our volatility risk premium strategy and the S&P 500 over this entire period. And it turns out that the correlation, right, is actually close to 0. Okay. So apart from being a hedging tool for equity exposure, volatility is also useful as part of a portfolio because it is uncorrelated to many other strategies. So this is a correlation table for some of the strategies that we developed at AllQuant. You can see that our volatility strategy has very low correlation with our other strategies. So this is a very rare quality for any quantitative strategy that you can develop. Okay, very seldom you can find one that really has very low correlation with other strategies that you already have. Okay. So we have seen how the benefit of adding volatility as an asset class. But let's also take a look at the flip side, right? Let's look at the potential pitfalls of trading volatility. I've mentioned earlier before that the simplest approach to hedging an equity portfolio is to just keep buying put options, okay? So in reality, right, there are institutions that actually do this, but they are fully aware that they are throwing money down the drain over the long run. The reason is because most options expire worthless and the premiums paid is wasted. However, the institutions are still willing to treat it as business costs because they want to protect their portfolio against significant losses during an unexpected crisis. Okay, but on the other hand, if you are buying vol not as part of an overall portfolio hedging strategy, but simply to just outright to try and make some money, you're basically fighting against gravity. Okay, so in recent years, right, there has been a proliferation of exchange traded products that retail investors can use to trade vol. One of the most popular instruments is the VXX, which basically replicates a long exposure to VIX. Now, VIX is nothing but the implied volatility of S&P 500. So this instrument is designed to lose value over time, as you can see in this long-term price chart of VXX. So although it is not exactly the same mechanism as option decay, but it is similar, it has to do with the nature of the term structure, which we will look at shortly. So remember that you can long vol by buying VXX, but note that it is not meant to be held over the long term, okay? So then is VXX a perfect candidate to short since it is guaranteed to lose value over time? Now, in fact, there is another instrument, right, which is the opposite of VXX. Hence, if you want to short VXX, you can simply buy this other instrument. This instrument is called SVXY. And it is designed to give the inverse exposure to VIX. So if the VIX drops by 10%, SVXY is expected to rise 10%. Okay, so you can see that prior to 2018, right, SVXY had been increasing steadily, which is what you would expect, right, since VXX has been steadily going down. However, there was a sudden plunge of 93% in 2018. Now, but if you look at the VXX chart, right, it doesn't seem to register that there was a huge spike in volatility at the same time. Okay, so what happened here? In fact, actually, volatility did indeed spike more than 100%, but you cannot see it because of the chart, right? VXX started from a very high price and then it decayed over time. So by the time we reach the year 2018, right, basically the price is so low that any movement on the VXX does not even register on the chart itself, okay? But rest assured that the volatility did indeed spike by 100%. But what happened was that it actually jumped from a very, very low base. Okay, in fact, the VIX, right, was trading below 10 before the spike. So even a move back to 20, right, which is the historical average level for VIX, it already represents a move of 100%. So herein lies the problem with short vol positions. VIX can spike more than 100% suddenly and without warning. So that was what happened overnight in February 2018, right? And your short vol position can be wiped out just like that, okay? In fact, this event was so bad that the issuer for SVXY decided to delever the instrument by half. What this means is that SVXY is now only half as sensitive to the movement of VIX as before. If VIX drops 10%, SVXY is now only expected to rise by 5% instead of 10%. Okay, So trading volatility, right, is like choosing between two poisons. You either experience slow bleed when you long vol, or you might risk sudden death when you short vol. Okay, so this is essentially something that you need to bear in mind when you want to trade volatility in your own portfolio. Okay, but having said that, as long as we are aware of this pitfall of trading volatility, there are ways to minimize the risk, and on the whole, the benefits of trading vol outweighs the risk, okay, especially as part of a multi-strategy portfolio. Okay, so now let's try and understand why VXX is designed to lose value over time. So we need to look at the term structure of volatility, or more precisely, implied vol. So recall I mentioned that implied vol is backed out from option prices, right? So options have multiple expiry dates. Some expire in 1 month, some expire in 6 months, and some expire even later on, right? So hence we are able to back out an implied vol for each option with different expiring months and plot it out on the chart like this. So what is interesting is that options with a longer expiry date tends to also have a higher implied vol. But this is actually to be expected because there is more uncertainty the further out into the future you go, right? And this is priced into the implied vol of longer dated options. Okay, so this is the typical shape of the vol term structure. You can actually trade the implied vol for the different expiries using futures. In fact, this is how the issuer of VXX replicate the long exposure to VIX. But the problem with using futures is that it eventually expires. Hence, you need to constantly roll over to the next futures when the current one is near expiry. However, the longer dated futures typically have a higher price than the expiring futures. So what the issuer really need to do, right, is to sell the expiring futures at this price and buy the next futures at this higher price. Okay, in fact, he has to do this constantly, selling low and buying high. So I'm sure all of you know that this is a recipe for disaster in the stock market, right? If you keep selling low and buying high. Although the term structure is in this shape most of the time, the shape can change and it can even invert, whereby short-dated implied vol is higher than a longer-dated implied vol. So again, this likely happens during an unexpected event that drives short-term uncertainty a lot higher. So when the term structure is inverted like this, VXX actually starts to benefit from rolling, as the replacement future is now cheaper than the expiring one. But on the other hand, it is SVXY's turn to suffer from this rolling cost. Okay? Now we've come to the end of today's presentation. So if you're interested in implementing quantitative approaches similar to the volatility risk premium strategy which I've shared today, you can scan this QR code, you can fill in a simple form, and either Bernard or Dawei will be in touch to get the conversation started, right? So we will share more about this arrangement on the 25th of September, but meanwhile, you can also scan this QR code for more information. Okay, so now I'll hand over to Bernard, who will administer the lucky draw quiz questions. So there will just be 2 simple multiple choice questions related to today's topic. You should be able to finish each question in under a minute. But in the meantime, if you have any questions with regards to today's topic, feel free to type your questions into the Q&A box. We will have a short Q&A session after the quiz. Okay, so good luck for the quiz, and I'll talk to you again in a short while. Bernard, over to you.
Thank you, Patrick. Yeah, it's always wonderful hearing the sharing from both of you guys, coming in from both a technical angle and simplifying it such that it's actually available for our understanding. And as what I've promised, all of you guys, in every single lecture sessions that we are running through, we always end off with the Q&A and also with the quiz. And all these quiz questions will be contributing towards the lucky draw at the end of the festival. So Dawei, when you're ready, maybe you can have the few quiz questions. And while that's being prepared, at the same time, we can be running the Q&A concurrently as well. So Patrick, I think you have shared a lot, and maybe some of the questions, if I can get Ingguan to come in to help us cross over with it. And I think in the Q&A panel, there are a few questions coming in. Yeah, and maybe just to answer one key question first before we jump on over to the quiz. I think there was discussion asking about the Black-Scholes methods and of course contrasting it versus for options, American options and European options. Ingo, I think you see the questions as well. Any chance that you can help us to clarify regarding about the Black-Scholes model?
Hi. Okay, but yep. So I saw the question. So you're right. Okay, Black-Scholes is specifically just for European options. I think what Patrick here is showing is just the most generic and basic form of the pricing formula for pricing options. Okay, but to price American options, okay, actually there are a lot of considerations that need to be taken in when you want to try to price an options. So besides whether it's American options or European options, by the way, for those who don't know, European options are only being able to exercise on the expiry date itself. An American option, then you have the option to exercise it at any point in time, okay, even before the option actually expires. So this is one factor. Then you're also going to factor in whether the underlying stock of your option, does it pay dividends or don't pay dividends. So all this have implications into the formula itself. Okay, so a Black-Scholes can only price kind of like a simple European option, right? So if you want to price more complicated options, you're probably going to make use of things like your Lattice pricing method or your Monte Carlos, right? And Monte Carlo can probably price anything you want, right? So you can even have very complex structured product comprising of various different options, which you can generate the pricing or the options itself using the Monte Carlo calculations of method itself. But I think it's beyond the topic of this webinar, not given a little bit of time that we can go into this. So, but yes, no, generally the person that just raised up the question is correct. Okay, yeah.
Yeah, I just want to quickly jump in here. So I don't want to detract from the main points of today's lecture, because now the formula for calculating option prices, right, is very technical, and in fact, this is the domain of professionals. But honestly speaking, if you want to trade volatility, right, you don't really need to understand or even know the formula behind option pricing. Now, but the key message here is that volatility, right, is indeed something that is an interesting asset class, and there are interesting characteristic behind this asset class. So you just need to understand like how it works and what are the pitfalls of trading volatility as an asset class. Okay, so talking about pitfalls, right, maybe I'll just jump on to answer one of the questions that I've seen, and that is how do we minimize the volatility pitfalls, right, behind trading volatility. Okay, so there is no way, right, to 100% avoid getting hit by these pitfalls. All we can do is to minimize the damage, right, when such a thing happened to us. Okay, so one of the ways to, first of all, minimize potentially being hit by this pitfall, right, is that we try to minimize situations where there might be a higher probability where volatility can spike, and when it spikes, it can easily spike up more than 100%. Okay, so I can think of a few possible scenarios. So if, let's say, volatility is trading at a very, very low level, right? Like for example, I mentioned during the presentation, like the VIX was trading at under 10, okay, before the big spike in February 2018. So situations like this, right, you know that any slight movement in the volatility itself to the upside, right, is going to represent a huge move in terms of percentage terms. So maybe in that kind of situation, you might not want to expose yourself to a short volatility position. Okay. Now, in terms of minimizing damage, right, in the unfortunate situation where you get hit, is to not trade too large a size in terms of your portfolio, right? So I wouldn't recommend trading volatility itself as a strategy for your entire portfolio. Okay, that is definitely not recommended. And even if you do use volatility in your portfolio, right, size it down to the extent where you price in the worst case scenario. Even if the event that your position gets wiped out, right, what would be the impact, okay, you take on your portfolio level? So if you're prepared for that scenario, right, then I would say that you have, in a way, protected yourself, that even if you do get hit, you won't get hit that badly. All right.
Yes, thank you. Thank you for those answers. And now let's jump over to our quiz that we will end off this whole session with. And those of you guys who have been with us for a while, you know that we have AHA slides over, and there are 2 MCQs available, yeah, for us to be answering. Of course, we gather all of you guys together based on your last 3 digits or your IC number or your passport number or your FIN that you'll be keying later. And of course, we have 60 seconds for each quiz. If you did not catch the QR code just now, it is okay. Right on top, you will still see that the URL is over there on ahaslides.com/70 for Oscar, Z, and C. And of course, the very easy way is to just whip out your handphone, your mobile phone, change it over to the QR code scanner and scan on this QR code. You will be able to join us. And of course, we only have a very small proportion of people who have scanned this code, looking at the numbers out of all those of you who are attending. And I will assure you that this session is not only for our Singapore friends and the students, but also for all our overseas participants who are with us on this lecture as well. So click on in and sign on, and we will just still leave on the URL all the way on the top across for all of you guys. Yeah, so let's move on to the details. And as what I shared, there will be 2 key questions, and no worries, it is not as hard as what we all think it is. Yeah, there'll be a field that pops up across in your name. Fill in the last 4 characters, which is the numbers and the alphanumeric of your IC number, passport number, or even your foreign identification number. Or for those of you overseas, maybe just the 4 characters of your SSNs, your name and your email address, so that we can notify you when we identify you as the winning persons. So once things are ready, let's progress on over to the first questions. Yeah, while everyone's joining in, once you're ready, let's get the quiz started. We have 60 seconds for each question. Okay, a little bit of technical issues, but let's go back over to the first questions. Yes, thank you. While our crew behind is actually sorting this out, we want to let you know that the next sessions of our festival will be on the 21st of September. That's when we are going to talk about the all-weather strategy and how we are going to thrive in both an up and downwards market cycle. Of course, right now, in the last 2 weeks plus, we do see that the market has been pretty volatile, especially with all the governmental policies that's been imposed by the China government on the technology sectors. Again, I think a few weeks back, you have heard about how the China government has came in on very strict policy on the educational technology sectors. That has been something maybe even a little bit scary to some friends who has been investing into the markets. And again, I think towards the end of the sessions, we will be expecting our students challenge to come in on the 2nd of October to be sharing regarding about how they will be looking at investing a pseudo 100,000 portfolio across for all for their case study. And yeah, I think we have gotten things ready. We're going to start the quiz pretty soon. Yeah, so let's start the quiz. Yeah, the first questions. Yeah, we will have 60 seconds for everyone. So it comes in, what is volatility in relation to the price of exchange traded securities? 4 answers across for you. Please click on the right answer. While everyone is thinking about which is the right answer, I think we will have, it should be an easy question for many of you guys. Looking at, is it the difference between the highest price and the lowest price? Or is it a measure of how much the price fluctuates around the average? Or even, I think we mentioned, is it not important at all? Or is it even the maximum loss ever experienced by securities? Just last 3 to 4 seconds up, we'll be revealing the answer quite soon. Yes, time's up. And wow, pretty much almost all of us have answered correct. Yes, it is a measure of how much the price fluctuates around the average. And let's move on to the next questions. Yes, and again, we have 60 seconds just for everyone to key in your answers. And again, we want to let you know it's not about the fastest finger, it's really just getting it right. And what is the difference between implied and realized volatility? So we have 4 answers available. Choose the right one and click on it on your phone. Oh, yes. Thank you for those of you guys sending in your love, your likes, and even your funny emoticons. Yes. And now that we have 4 key answers. Thank you, Stella, Keith, Terry. And what is implied and realized volatility? Just the last 5 to 6 seconds for all of us. The answers will be shown right now. Yes, it's actually the implied volatility, which is derived from the option prices. Yeah, and we have almost all of you guys who have gotten it correct. Yes, thank you for participating in this challenge. Yes. So just to take over on the slides over here. As what we have shared, today is the 18th of September. We will be looking forward to seeing all of you online on the 21st of September. And if you have learned a little bit or you have gained a little bit from today's sharing and the last 3 sessions, do get your friends along as well. We have gotten very good permission to share all this content without charges to anyone. And those of you guys who have attended AllQuant's education seminar before, you will understand that they come in at a pretty hefty price. Okay, thank you for joining all of us today. And I think we'll end of the session over here right now. And we look forward to seeing you a few days away in the Quantitative Investing Festival. Thank you, have fun, and stay safe. Goodbye.
Thank you. Bye-bye.